Wednesday, November 19, 2025, brought a notable shift in European financial markets. After a tense period marked by persistent declines, the mood across trading floors was noticeably different as the day began. Investors and analysts alike were watching closely, hoping for signs of stabilization after a turbulent stretch. After 4 consecutive days of losses, major indices across the continent rebounded, signaling a break in bearish momentum. The sudden uptick was met with cautious optimism, as traders weighed whether this was a genuine turnaround or just a temporary bounce. The Stoxx 600 index rose 0.83%, with Germany's DAX, France's CAC 40, Italy's FTSE MIB, Spain's IBEX 35, and London's FTSE 100 all posting solid gains. These broad-based advances reflected renewed confidence, at least for the moment, in the resilience of European equities. This broad rally offered a collective sigh of relief for investors, who saw a potential buying opportunity after the recent dip. Many market participants had been waiting on the sidelines, and today's gains encouraged some to re-enter the market, hoping to capitalize on lower prices. The previous losing streak had fueled anxiety about stretched valuations and a possible correction. Concerns about whether stocks had become too expensive were widespread, and the recent declines had only heightened those fears. Wednesday's gains, however, didn't erase deeper concerns. Geopolitical tensions and questions about corporate earnings still lingered. Ongoing uncertainty about global events and the health of major companies continued to cast a shadow over the markets. Analysts viewed the rebound as a temporary reprieve, not a fundamental shift. Many experts cautioned that the underlying issues driving recent volatility had not been resolved, and that further swings could be ahead. The optimism was fragile, with many wondering if this was the start of a new trend or just a brief pause before more volatility. Investors remained divided, with some predicting further gains, while others braced for renewed selling pressure. The day's positive close was a moment of respite in a market still on edge. For many, it was a welcome change, but the sense of uncertainty lingered as the trading day ended. Investors remained cautious, aware that underlying risks persisted. Many continued to monitor economic data and global developments, wary of making bold moves until a clearer trend emerged. The real test would be whether this rally could sustain itself in the days ahead, as markets continued to search for direction amid a complex and uncertain global landscape. European markets' rebound was part of a global story dominated by the explosive rise of AI and tech stocks. Months of AI-driven enthusiasm pushed valuations to dizzying heights, sparking fears of a bubble. The recent 4-day slide in both US and European markets reflected this anxiety, as investors questioned whether the rally had gone too far. Profit-taking swept through, especially in high-flying tech names, fueling the sell-off. The S&P 500 also snapped its losing streak, mirroring Europe's recovery and highlighting the interconnectedness of global markets. A synchronized rebound underscored shared hopes and anxieties on both sides of the Atlantic. Yet, the central debate over tech valuations remains unresolved. Investors are anxiously awaiting signals, especially from upcoming tech earnings, to determine if current prices are justified. The market's next move hinges on whether the AI boom can deliver real, sustainable growth. At the center of market anticipation stood Nvidia, the bellwether for the AI sector. As the leading player in AI technology, Nvidia's performance was seen as a barometer for the entire industry. Investors awaited its quarterly earnings, knowing the results could either reignite the tech rally or trigger a sell-off. The stakes were incredibly high, and the market was on edge. Analysts expected another strong performance, but the real focus was on Nvidia's guidance for future growth. Would the company continue to lead the AI revolution, or were there signs of slowing momentum? Even a solid report might disappoint if it hinted at slowing momentum. Investors were particularly sensitive to any indication that the explosive growth might be tapering off. Recent profit-taking in Nvidia reflected fears that the stock's meteoric rise had already priced in perfection. The market was jittery, and any misstep could lead to a significant correction. The atmosphere was tense. Some investors bought the dip, betting on a blowout report, while others stayed cautious. The divide was clear: optimism versus caution. Nvidia's earnings had become a global event, with the potential to set the tone for the rest of the year. Financial news outlets around the world were tuned in, waiting for the announcement. The outcome would determine if the AI-driven bull run had more room to run, or if a reckoning was near. The implications were vast, affecting not just Nvidia, but the entire tech sector. The stakes were high, and the market's reaction would be swift. Traders were prepared for volatility, ready to act on any news. For now, all eyes were on Nvidia to see if it could deliver another round of AI-fueled optimism. The anticipation was palpable, and the world was watching. The results would ripple far beyond the company itself, influencing global markets and the future of AI technology. Not all sectors shared in the market's gains. Aerospace and defense notably lagged. The sector's index fell to a 2-month low, down 1.9%, after reports surfaced of a possible Ukraine-Russia peace plan. Even unconfirmed, the news sent defense stocks tumbling, as the prospect of peace threatened future revenue streams. German firms like Rheinmetall and Renk saw their shares plunge 7% and 8% respectively. The sell-off highlighted how much recent growth depended on ongoing conflict and elevated security spending. Defense stocks are uniquely vulnerable to geopolitical shifts. A single headline can reshape their outlook overnight. The market's reaction was a stark reminder of the risks tied to this sector. Investors were left questioning whether the peak in defense spending had already passed. Amid the rally, Vivendi stood out for all the wrong reasons. The French media giant's shares plunged 12.7%, at one point down as much as 20%. The drop was triggered by reports of a likely court ruling favoring Vivendi's largest investor, Bolloré Group, in a shareholder dispute. Investors feared the decision could reshape the company's governance and strategic direction. The uncertainty sparked a massive sell-off, with the final ruling still pending. This episode underscored how legal battles and governance issues can drive sharp moves in stock prices. For Vivendi, the path forward remains clouded by legal risk. Even on a day of market gains, company-specific drama can inflict heavy losses. Nokia's day was a roller coaster, ending with a 7% drop despite a major strategy announcement. The company unveiled a new AI-focused vision and ambitious profit targets for 2028, alongside a corporate reorganization. Initial optimism faded as investors questioned the feasibility of the plan and the distant timeline for results. The market's skepticism was clear. Ambitious goals weren't enough to offset concerns about competition and execution. Nokia's reversal was a harsh lesson. Bold strategies need credibility to win investor trust. The company now faces the challenge of proving it can deliver on its promises. Investors want more than buzzwords. They want results. The share price decline signaled a lack of confidence in Nokia's turnaround. The road to regaining trust will be long. The luxury and retail sectors saw contrasting fortunes. Kering's shares fell 4.2% after its CEO set an 18-month deadline to revive its brands, raising doubts about the turnaround speed and scope. The plan to downsize stores and reduce reliance on Gucci left investors skeptical. Meanwhile, WH Smith surged 6.8% after announcing its CEO's departure following an accounting scandal. The leadership change was welcomed as a fresh start, helping the stock rebound from a 52-week low. For Kering, the challenge is execution. For WH Smith, it's rebuilding trust. Both stories show how leadership and strategy can quickly shift investor sentiment. The market rewards decisive action and punishes uncertainty. These moves highlight the power of company-specific news amid broader market trends. In the UK, new economic data has brought a much-needed glimmer of hope for both consumers and businesses, who have been grappling with rising costs for months. After a long period of uncertainty, there are finally some positive signs on the horizon. Annual inflation cooled to 3.6% in October, matching forecasts and continuing a steady downward trend from previous months. This marks a significant improvement from the double-digit inflation seen last year, and suggests that the worst of the price surges may be behind us. This moderation in inflation has eased pressure on household budgets, allowing families to breathe a little easier when paying for essentials like food and energy. For many, it signals that the relentless squeeze on their finances could finally be easing, at least for now. The encouraging data has fueled speculation about a potential Bank of England rate cut, possibly as soon as December. Investors and analysts are now closely watching for any signals from policymakers. While the FTSE 100 stock index gained ground on the news, the British pound slipped, reflecting growing expectations that interest rates could soon be lowered to support the economy. Lower inflation makes rate cuts more likely, which can help boost economic activity, but it also tends to weaken the currency as investors seek higher returns elsewhere. Economists saw the latest data as a green light for policy easing, especially with the labor market showing signs of softening and GDP growth remaining sluggish. These factors together point to a need for more support from the central bank. The focus now shifts to the bank's next move, as markets and households alike await further guidance on the path ahead. A rate cut would mark a major policy pivot after a long and challenging tightening cycle, potentially ushering in a new phase for the UK economy. For now, the UK's economic outlook is finally showing signs of relief, offering hope that better days may be ahead for consumers, businesses, and the country as a whole. Despite cooling inflation, UK government bond yields rose, defying expectations of a rate cut. The 10-year gilt yield climbed 4 basis points, while the 30-year spiked above 5%. This move suggests investors are wary of the UK's fiscal outlook and global bond market volatility. The divergence between falling inflation and rising yields complicates the Bank of England's decision. High borrowing costs could tighten financial conditions even if rates are cut. Policymakers must balance inflation control, economic support, and bond market stability. The next Bank of England meeting will be closely watched for signals on the path ahead. The stakes for the UK economy and its markets remain high.